Good morning and welcome to Capital Sound. Oil is surging, overnight futures are softer, and yet the stock market just ripped higher. How does that make sense? I am Mandy Prince, and with me today is Franklin Pierce.
Good morning, Mandy. Great to be here.
Quick snapshot before we dive in. Equities have been firm lately, even as pre-market tone looks cautious. Volatility is still subdued and yields have moved modestly higher. Energy has led while parts of growth have lagged a touch. Those are the numbers. The real question is why the rally feels so at odds with the inflation signal from oil. Franklin, let's jump right in. How do stocks surge when oil is screaming inflation and futures are red? Is the market just intoxicated by de-escalation headlines?
Here is my thesis in plain terms. The rally is mispriced because the policy math is tightening, even if headlines feel calming. When energy prices spike, that filters into inflation expectations and real rates, and that changes how the central bank has to think. It is reminiscent of 2022's inflation whiplash wearing a fresh war label. Markets are partying while the central bank is loading the punch bowl back into the truck. That tension is not fully reflected in equities.
You are already landing a strong claim. I want to split this into two lenses to help listeners, the macro policy math versus the market plumbing. So first, lay out the policy math, then we'll do the market plumbing. Walk me through why oil changes the central bank's posture.
Let me start with the logic. Energy is not just a headline, it is a tax on consumption. When households pay more for gasoline, it leaves less for everything else. That is a fiscal transmission, and it matters just as manufacturing shows signs of life. The central bank sees inflation pressure from energy while growth looks resilient, and the balance tilts toward inflation vigilance. That lifts real rates, even if policy doesn't move immediately. The conclusion is that the policy backdrop is tighter than the rally implies.
Hold on, translate, fiscal transmission, and real rates for people not staring at a Bloomberg terminal.
Sure. Fiscal transmission just means it hits people's wallets directly, like a tax, and real rates are the borrowing costs after inflation. If inflation feels sticky and rates are already elevated, real rates rise, and that makes it harder for risk assets to keep sprinting.
Okay, now the market plumbing lens, some people say this rally is a trap because of positioning and liquidity, not because the macro story is wrong. Where do you stand on that?
I observe that the market's plumbing matters a lot right now. The equity rally is surfing a wave while the tide is still going out. Oil is the undertow when the market rallies on de-escalation headlines, but the underlying inflation impulse doesn't fade. You are leaning on optimism rather than balance sheet capacity. If the repricing of tighter conditions is slow, the market can snap lower when the reality catches up. That is the fragility.
That is colorful, but I need to push you a bit if you are saying it is fragile. What is the mechanism? Give us the why, not just the vibe.
The mechanism is a three-way liquidity squeeze. First, oil-driven inflation keeps real yields elevated. Second, Japan's rate shift can unwind yen carry funding, so global liquidity tightens. Third, volatility. Targeting strategies mechanically reduce exposure when energy volatility rises. Those forces can trigger a downdraft even if the headline tone improves.
And for listeners, yen carry funding and vol target strategies are very Wall Street terms. Put that in plain English.
Absolutely. Yen carry is when investors borrow in Japan at low rates and invest elsewhere. If Japan's rates rise, that cheap funding gets less cheap, so people pull back. Volatility target strategies are basically funds that reduce exposure when markets get jumpy. More energy volatility means those funds can sell equities regardless of the narrative.
So let's do the clash. Is this rally mispriced because of policy math, or is it a trap because of liquidity? I want you to argue both sides, then tell me where you land.
The policy math case is simple. Energy inflation means the central bank stays cautious, and that is a headwind. The liquidity trap case is the market celebrated de-escalation, but the financing plumbing is tightening, and that makes the rally vulnerable to a mechanical sell off. I lean toward the policy math view as the primary driver, with liquidity as the amplifier. In other words, the policy backdrop sets the stage, and the market plumbing determines how dramatic the next move could be.
You are linking them. That is helpful. But I can hear listeners say, we just got a solid manufacturing bounce. So doesn't that argue for growth and justify higher stocks? What is your response?
It is a fair question. Manufacturing resilience can support earnings, but it doesn't erase the inflation tax from energy. If demand looks sturdy and prices are rising, the central bank prioritizes inflation over growth. That creates a paradox. Strong data can tighten financial conditions. My first instinct was to cheer the rebound, but when I mapped the energy pass-through, I concluded it doesn't give equities a free pass.
That is not what most people want to hear. I am hearing good data can be bad for stocks. Is that the message?
In a narrow sense, yes. If inflation is still the dominant concern, this is not a perpetual rule, but in a phase like this, growth strength without inflation relief keeps policy tight. That is the crux.
Let's zoom out to Japan because you brought it up. Some see Japan's rate shift as a sideshow. Others see it as the silent catalyst. Is Japan the spark here?
I view Japan as a compounding factor, not the sole spark. If the funding cost rises there, it tightens global conditions, and that can matter for us equities. It doesn't drive the story alone, but it can turn a regional wobble into a broader liquidity drain. I've seen this movie before, and it doesn't always show up in the headline data first.
Liquidity drain again. Translate that.
It just means there is less easy money sloshing around markets. When funding gets pricier, investors reduce risk, and that can pressure equities even if the economy itself doesn't change much.
Now I want you to argue against yourself. What would make you wrong by the open?
Two things. One, if energy prices retreat quickly and sustainably, the policy pressure eases. Two, if the market clearly reprices tightening risks gradually without stress, meaning funding costs don't spike and volatility stays calm, then the rally could be more durable than I think. I'd be watching for signs that the inflation impulse is fading and liquidity is stable.
And I am going to force the other side too. What would make the trap story fade?
If investors re-risk into cyclicals and small caps with improving breadth while energy cools, the plumbing risk diminishes. In that scenario, the rally has a more solid base rather than just momentum.
I want to challenge one piece. You said energy is a tax on consumption and that it forces policy vigilance. But if corporate margins hold, doesn't that cushion equities?
It can, and that is the nuanced part. Strong businesses with pricing power can protect margins, but the aggregate market isn't just the strongest companies. The broad market feels the squeeze on consumer demand. The way I reconcile it is quality can do fine, but the average stock struggles. That is where management quality matters. Good managers absorb shocks better.
That is your gravity anchor for listeners who want a framework. No stock picks, just a way to think. What is your approach here?
This is a period where patience beats speed. Reduce the number of decisions you make. Focus on businesses with durable demand, disciplined capital allocation, and strong R&D that actually translates into products. The selling decision should be rare, not routine.
That is the guidance people need. Now, I want a real world context. Have you seen this pattern before?
In 2022, we saw a rapid sequence where inflation surprises forced policy recalibration and markets oscillated between relief rallies and tightening reality. I got burned leaning too hard into the first relief rally. It reminded me that policy math can overtake sentiment faster than you expect.
That is a good human moment, and I appreciate it. Let's bring in your scuttlebutt lens carefully. What are you hearing on the ground that complements the public data?
From conversations across the supply chain, the common thread is cost uncertainty, not necessarily demand collapse. That aligns with what filings show. Companies can still sell, but planning is harder. It doesn't replace the official data. It just tells me the inflation impulse is still real.
That is one. We'll leave it there. Now, I want to give listeners a structured fork in the road, but not a prediction. Give me two paths from here. One if things calm, one if they don't.
Scenario A, if energy prices cool and stay stable, then inflation pressure eases and the central bank can stay on hold. The signal to watch is whether energy volatility settles and breadth improves beyond a narrow set of names. Scenario B, if energy stays elevated and volatility rises, then liquidity tightens and equities face a downdraft. The early warning sign is rising stress in funding markets and broadening weakness across risk assets. I think the calmer path is possible, but I assign higher odds to the risk path until we see sustained energy relief.
That is clear. One more moment where I translate. You said funding markets. That just means the cost for big institutions to borrow and invest, right?
Exactly. When those costs go up, risk appetite usually goes down.
Now, I want to bring in the IPO window because people ask about that a lot. If the market is as fragile as you think, what does that mean for new listings and deal flow?
It means the window can be open, but it is thin in uncertain periods. Quality issuers with strong stories can still get through, but timing is more sensitive. If energy volatility keeps rising or liquidity tightens, the window narrows quickly.
Okay, we're getting toward the end, and I want to do our one to key away moment. If listeners remember just one thing from today, what should it be?
The rally can look healthy while the policy math tightens underneath. Focus on business quality and keep your decision count low.
That is crisp. Let's close with a watch list for the next 24 hours. I'll set the table. You fill it in. Here are my three buckets: energy, rates, and global funding. What specific things are you watching?
Three items. First, crude and gasoline levels, specifically whether crude can settle below around 90 and gas below 4, because that would ease the inflation impulse. Second, real yields and how quickly the market prices tightening risk. If that reprices faster, it is a headwind. Third, the yen and short-term funding rates, if those move against risk. It hints at a liquidity squeeze and a tougher environment for IPO timing.
Let me repeat that in plain terms. Watch energy prices for inflation relief, watch rates for how tight policy feels, and watch the yen and short-term borrowing costs for any sign that liquidity is draining. That is the checklist.
And I'll add one line: outstanding companies still compound through noise, but the market will test patience.
Thanks for listening to Capital Sound. We'll be back this evening with a full recap of how the day played out. Have a great trading day, and goodbye.